All right. Okay, we are live on Facebook. And Andrew, are you ready to get going?
I'm ready. I'm ready and ready to go.
Wonderful. Let me just move this over. How do I move it to the center? Sorry, I just got to move something over. Oh, there we go. Okay, and then up. Okay, perfect. Okay, all right. Let's get this party started. All right. Okay, you ready?
I am ready.
Awesome. Awesome. Well, hi, everybody. I am Cynthia Cohn, and thank you so much for joining us today. I am actually here live from my living room in Pasadena with a special guest joining me for this week's Fireside Chat. As many of you know, I own a boutique residential real estate brokerage right here in Pasadena, California, called Cynthia Cohn and Associates, and I'm very proud to lead and own one of the very few women-owned residential real estate firms in California. As my real estate career has grown over the past 20 years, really so has my passion for protecting, caring for, and creating maximum results for my clients. And one of my favorite parts of owning this business is really bringing people together and serving as a trusted resource to my network. I started hosting these fireside chats as a way to do just that. Each month, I invite a special expert in their field to join us here at the Fireside Chat and really to answer some of your questions and really give you insight into the more nuanced industries and markets. Some of the past Fireside Chats that we had Cal Anton and John Thompson with Simple Mortgage, who talked about the 2021 real estate market through the buyer's lens, and that was really just terrific. I also visited with Yolanda Isham, a broker up in Arizona, talking about the real estate market in Arizona, the pluses, the minuses, and it was just so interesting hearing all about the state of Arizona and the real estate market there. And I also had one of my friends, Sam Lamb, with State Farm Insurance, discussing homeowners insurance in high fire zones, and that was extremely interesting. And here we are today, almost the middle of November, right here in my living room. Although I don't have the fire going, but next time I do the fireside chat, I'll definitely light it. Today, I have Andrew Lowe joining us. This is going to be a really great presentation. I met Andrew through Provisors. He is actually the Senior Vice President of Wealth Management at UBS. He works with clients and his prospects to really create a blueprint and an investment strategy and plan to help his clients save enough financial resources to actually fund their retirement, fund their lifestyle, fund their charitable endeavors, and really to help them simplify and come up with goals for wealth transfer. So really, this is going to be so interesting. While working with business owners over the past 12 years, Andrew has found that many are frustrated at paying high taxes. Gosh, aren't we all? And specifically capital gains taxes, sometimes up to 50% upon the sale of a business. So it's a lot. He actually collaborates with his clients and other legal and tax advisors to really create a roadmap for his clients and an action plan to really help these business owners and other clients with liquidity events to really help them reduce their income and capital gains taxes by using advanced tax and trust strategies. And I know this is always so important because so many of us in the state of California have trouble moving because we're going to be having to pay a lot in capital gains. So this is one of the reasons why we have such a limited inventory in our state. But before we jump in, I would really love it if Andrew could share a little bit about himself. So Andrew, welcome to the Fireside Chat.
Cynthia, it's always a pleasure to be with you. You're in good hands with Cynthia. Not only is it a woman-owned business, but she cares so much about her clients that she's not just looking at doing the real estate transaction, but really looking holistically at really helping her clients get the most out of their sale, whether it's the sale of their home or investment real estate or whatever it is, to pay the least amount of taxes so you can take home the most. So I really consider it a privilege to be here with you today with you, Cynthia. So I was born and raised in the San Fernando Valley in North Hollywood, to be specific, and fourth out of five kids. We're coming up to Veterans Day tomorrow. And my dad actually served in the US Army during World War II. from 1941 to 1945. And he's passed away, but he would be 100 years old next year.
Oh my God.
But he really sacrificed and served in the Army. And not only that, he wound up spending 18 more months in a VA hospital after the war to recover. And so I'm very grateful to my dad and grateful for all the servicemen that have served, and recognizing Veterans Day tomorrow. And I also have the privilege of being married with 2 daughters of my own. And more and more, there are less and less people that are born and raised in California. And so I'm second generation California, and my daughters are third generation. So it's great to be here. I love helping families make the most with what they have, their assets, to prepare for retirement, to make a greater impact to their families, their loved ones, their charities, and less to Uncle Sam and the franchise tax board.
Well, and that's why I've got you here today. And I love hearing that you're a dad, and I love hearing the story about your father. How old are your girls, Andrew?
My older daughter is second year in college, and
Mhm.
my younger daughter is a freshman in high school. And she just finished her last marching band competition Saturday. It was an all-day event. So it's a
Oh,
joy always being involved with their lives and what they're doing.
I love that. I love that. Well, I'm really glad that you're here, and thank you so much for taking time, to join us. I know that, we have just a real limited inventory across the nation, and specifically, also right here in our backyard in Los Angeles. And before the pandemic, this was always already an issue, and the pandemic helped to continue that trend. So we're still working on trying to get out of that and build some inventory in our state, so our buyers, we can put our families into home ownership. How exactly, if I were to sell my home, how can you sell a home without paying income tax?
Well, for many people, they have their exemption if they own their home. If they're married, they have a $250,000 exemption, or if they're single, $250,000 exemption. If they're married, they have a $500,000 exemption. I have a sister that lives in San Marino, and so houses there are, they're not going for $500,000. I tell you that much. And so easily, if you sell your house for $3 million and you have a $250,000 exemption or a $500,000 exemption, and like my sister and like many people in the Pasadena area and surrounding area, they've owned their home for decades, or at least for many years. And so they probably bought it at a low price. And now when they sell it, if they sell for, let's say, 3 million, they're going to have to pay capital gains somewhere around, maybe 2.5 million, maybe $2 million
Mm-hmm.
of capital gains.
Mm-hmm.
And so a lot of people, they don't want to pay the gain. They don't want to pay the tax when they sell. And so there are different strategies, but a very good strategy for appreciated real estate is something called a Charitable Remainder Unit Trust, or a CRUT, a Charitable Remainder Trust. And instead of selling it in your own name, you transfer your title into a Charitable Remainder Trust, have the trust sell it. The trust is tax exempt, and then you get an income stream from that for the rest of your life. But not only that, you avoid the capital gain, you avoid the $2.5 million of capital gain, and you get an income tax deduction. You get an income stream for the rest of your life, but then after you pass away, then whatever is left will go to a charity of your choice. So that's one way to avoid paying any taxes when you sell either your primary home or an investment property.
Very interesting. Well, I know all about the exemption. And in fact, I was talking to a girlfriend of mine who is, in her 50s, like myself. And, they actually sandwich generation. They're just, getting the younger kids off into college and caregiving for a parent. So they're not going to do anything in the current residence that they're at. But I mean, definitely downsizing is something on their mind. But they bought this wonderful house in South Pass, for under $500,000, probably. I had meant to ask her what year she bought it. I don't know if it was 1998 or something like that, 99. But anyway, and of course, it's probably worth at least $1.8 million. And so again, even for someone, a little bit younger, it's almost impossible for them to make a change without paying a huge penalty.
Yeah, and that's unfortunate because there's a lot of people in that same predicament,
Yeah,
right?
yeah.
Their kids are out of the house, they want to downsize, and then they go and list a property and realize that if they sold it, they got to pay a huge boatload of taxes, not only to the IRS but the Franchise Tax Board.
Hmm.
And they're just looking at downsides. They don't want to pay all these taxes, and they're kind of stuck. And so if they own the home for quite a number of years, there's going to be a huge capital gain, and so that's the problem. And this would be one very good solution to help them be able to downsize, get an income stream to actually support buying another home or be downsizing to another home, and be able to do that without having to pay the exorbitant tax to either the Franchise Tax Board or the IRS.
Yeah, I really love that. I had Tony Phillips here a couple months ago, and it was really interesting because we talked about a different strategy, which was turning your residential property into a rental and then doing so that's really basically deferring taxes, but it was really effective option, really. So, but today we're going to be talking about the Charitable Remainder Trust, which is another option. And I don't know if there's too many other options out there. But anyway, let's talk a little bit and dive a little bit deeper into that. And I know you just mentioned about it. Can you just start kind of at the beginning and explain the Charitable Remainder Trust? Exactly how does it work?
Sure, and it's not a good fit for everybody, but
Mhm.
it's a wonderful fit for people uh, with appreciated real estate that want to sell, that don't want to pay the tax.
Okay.
And so what happens is that um, anybody with appreciated property, when they sell, whether it's your business or real estate or stocks, they're going to have to pay a capital gains tax. One way to avoid that is by having a tax exempt trust sell it.
Hmm.
And so instead of them selling in their own personal name, we transfer title to a charitable trust. And so you, as the real estate broker, would list the property being sold by the charitable trust.
Hmm.
So when the trust sells it, there is no capital gain upon the sale, and you get a tax deduction because um, when you pass away, when the seller passes away, eventually some of that money is going to go to charity. That's why you get a tax deduction. No
Hmm.
money goes to charity now, but only when they pass away, money goes to charity.
Hmm.
And then also, let's say that it's $3 million, 1.8 or 3 million. Let's just use a round number, $3 million. They're going to get cash flow on that somewhere. It could be anywhere from 150,000 to $180,000 for the rest of your life. So for a widow or even an older couple that that could use that type of income, cash flow of 150, $180,000 a year, they get that for the rest of their life. And then let's say they're married. If the husband passes away, the wife still gets the income stream. If the wife passes away, the husband still gets the income stream. Nothing goes to charity until they both pass away. So there's a sense of security for them to get that income stream for the rest of their life. And then whenever they do pass away, then whatever's left goes to a charity of their choice. And it could be a charity, it could be even a gift fund where their kids manage that and then they can use it to give to charity later on. But the good thing also about that is that they that asset is removed from their taxable estate.
Hmm.
So President Biden is looking to reduce the estate exemption from 11.7 down to 5 million here with some of the tax law changes. So if someone owns a home in Pasadena worth 2 million, they've got a retirement account of another million or two, and they have other assets, um, they're going to be subject to estate tax because eventually they're going to be over the exemption amount.
Hmm.
If they do this charitable trust, we actually take this piece of property, it's no longer going to be part of their taxable estate. So now we can get them underneath the exemption. So when they pass away, nothing will go to the IRS even. And then they'll have other assets. They've got the IRA, other assets that they can also give that to their kids as well.
I really like that. And I love that idea about, setting it up so the children can actually manage those funds for charity. And, assuming that, there's other assets, I guess, you're not going to be passing everything on to your children, just some of what you have to your kids.
Yeah.
Yeah.
And I always start with asking, questions and really understanding the priorities of what the real estate owner want. How much, what percentage do they want to give to their kids of their assets? What percentage do they want to give to charity? What percentage do you want to give to the IRS? Now, most people answer they want zero to the IRS. Well, if they want zero to the IRS, then we have to use some of these strategies to get zero to the IRS. So depending on what they say, then I craft a plan that would meet their goals and their objectives. There's one example of somebody else that they're a little bit older. They're in their 70s, and so they were trying to downsize. And it's a widow, and she wanted to downsize, but she didn't want to pay the tax on selling the house. And she's been trying to downsize for 3 or 4 years. And then I got involved and just asked her a lot of questions. It turned out that she wanted to help her kids with a little bit of income when she passes. And so what they did was that we did a charitable remainder trust. We had the house put into the charitable trust. So the real estate agent broker is going to list the house as a charitable trust selling it. And we gave her an income stream. When she passes, then the income stream goes to the kids. So now the kids get the income stream. And then after a certain number of years, then it goes to charity. So that met all her goals. She wanted to get income for herself, but she also wanted to help some of her kids, a little bit supplement their income. So when she passes, income went to the kids, and then it went to charity after a certain number of years.
Interesting. And what did you use to generate that cash flow and income stream for her to live on?
Right. So let's say, Cynthia, you list a house tomorrow, right? And it gets sold, New Year's Eve, whatever, right? So when the buyer buys a house, in escrow, the proceeds, the cash will be in that charitable remainder trust. And then inside that trust, then I will invest it for the longer term, and we'll try to grow it, somewhere between 6 and 8% per year. And so that will generate the income stream that the client needs. But also, there's this principle called worst in, first out accounting. And so what I want to do is I understand that. So I'm going to generate the income, the cash flow to them so that they're not taxed at ordinary income tax rates. It's going to be taxed at long-term capital gains rates, which is going to be a lot lower tax rate.
Interesting. That's really interesting. And what does it actually cost to set up the charitable remainder trust?
The cost, it depends, so again, I have to give full disclosures. I'm a senior vice president at UBS. We're a financial services firm. So we don't do legal, we don't provide legal or tax advice. And, all of this is for education today. For your specific situation, consult your own legal and tax advisor. But typically I'll work with attorneys, whether it's the client's attorney or I have attorneys that we collaborate with that I know will be able to do this and draft it the right way, because these are advanced trusts. But they'll draft it. The cost to draft it, depending on availability and time and complexity, could be anywhere from $5,000 to $20,000 to draft those trusts.
Okay.
So if they're saving capital gains of $500,000 or more, it's well worth the $5,000 to $20,000 to save that.
Yeah, it sounds like it. And does it require like a tax return, annual tax return, the trust?
Yes, it requires an annual tax return. So the charitable remainder trust will have its own tax ID, and we'll help with all of that. And it'll file its own tax return, but since it's tax exempt, it pays no taxes.
I see.
And so, but it will file a tax return reporting to the IRS an annual filing.
Interesting. That is really interesting. So what else should I be asking you? Just think, I know we have the 1031 exchanges, but if you're tired of doing the exchanging and want liquidity or income from your house, is this another way to do that?
Yeah, so a 1031 is a wonderful way to defer the tax. Let's say that, again, you have that same $3 million house, or maybe it's an investment property, right? You bought a home and now you moved out of it and now you're renting that home. So it's no longer your primary residence, it's your investment property. And so I know plenty of people that, they don't want to pay the tax. So they do a 1031 exchange where they sell that and buy another home. And then that basis of that original home goes into the new home. So they're just deferring the tax, but eventually the tax will have to be paid. The unfortunate thing with that, though, is that there is no income stream, and it's still part of your taxable estate.
Yeah, that's what Tony was saying. But it seemed, so for your situation with the capital gains versus the exchange, what are some other benefits?
The other benefits is that once these assets are inside a charitable remainder trust, they're not creditor proof. They are creditor proof, I meant, and so they can't be attached, and so that's another benefit. And again, it's I know sometimes in California we're in a very litigious society, so it's not only it's judgment proof, it's creditor proof, and so that's the benefit. The biggest benefit is that we avoid the capital gain.
Mm-hmm.
In addition, you get an income tax deduction, and the asset is no longer part of your taxable estate. So whatever you're gifting to your kids, you're saving 40% at today's rates of gift and estate taxes later on, and it could be as high as 50%.
Mm-hmm.
Cynthia, would it be helpful if I just showed a quick illustration here? Would that
Yeah,
be
go
helpful?
ahead and why don't you share your screen?
Okay. So I don't know if you can see that, but let's say we put a $3 million piece of property in, right? And let's do the 6% payout here. 6% payout. So they're going to get paid 6% every year for the rest of their lives. They're going to get an income tax deduction of $475,590. Call it $475,000.
Mm-hmm.
If they do that this year, the income tax deduction is good for this year. If they can't use that full income tax deduction, they have an additional 5 years to use that deduction. So they have 6 years to use that income tax deduction. It'll offset their other income that they have and any income from cash flow from the Charitable Remainder Trust. As you can see here, the estimated income is that, in this case, Fred and Wilma Flintstone, he's 60 and she's 50.
Mm-hmm.
And their estimated income over 42.6 years, that's the IRS actuarial table of how long at least one of them will live. They're going to get income of 9.5 million over that lifetime.
Mm-hmm.
And then what's left to the charity, assuming our growth rate of 7%, would be about 4.5 million left to the charity. And that charity could be the Fred and Wilma Charitable Gift Fund, where the kids can decide where that money goes. And it doesn't have to go right away. It could be $10,000 a year, or maybe there's something that they want to gift to, and they'll just direct that money to go to that.
Mm-hmm.
But the key thing here is to get an income tax deduction. You avoid the capital gain of whatever it is, 3 million. You get an income stream, and I'll just show you what that income stream looks like. So that income stream here starts out at $180,000 a year.
It's a little bit hard. Sorry, Andrew. It's a little bit hard. Can you?
Enlarge it here.
Yeah, thanks.
Let's see if that works. There we go.
Yeah, that's better.
Okay. So it starts out at $180,000 a year, and then it'll grow a little bit, 181.8, 183, 185. We're growing at 7% a year, which is fairly conservative.
Mm-hmm.
We're paying out 6%. So there's a net growth of 1% a year. And so most of my clients like that, that income stream. It grows every year. It keeps up with inflation, right? So if they live, let's say they live, 30 years, right? Then their income stream will be about 240,000 a year by that time, and what would be left for charity would be about 4 million. In this case, the IRS actuarial tables say they should live 42 years, right? So 42 years would be right here. Their income would be about 270,000 a year.
Mm-hmm.
What's left for charity would be 4.5 million. But let's say that between either Fred or Wilma, they've got great genes, and they live to age 50. That's fine. They would continue to get the income stream until both of them pass away. Mm-hmm. So if they live to age 51, 296,000, and a little bit more goes to charity.
Interesting. And I think you said this before, but just to understand, those income payments that you're receiving is every year.
Right.
Is that something that can actually be passed along to your children? Let's say you don't need, the entire 200,000, and maybe you start gifting. What is the total they could gift?
Yeah, so they could, if they don't need that. So here's another thing that people will do. Let's say they don't need this income stream, right? Mm-hmm. They can gift it, and the annual. Let me stop sharing here. The annual gifting that they can do is $15,000 per person. So if I'm married and I am married, right, I can give away 30,000 to anybody I want without using any of your exemption.
Mhm.
So if I have got 3 kids, I can give 30,000 to child one, 30,000 child two, 30,000 child three, without paying gift tax,
Mhm.
right?
Mhm.
The other thing that we talked about is that this one lady, actuarially, she, supposed to live 11 years. And so after her, whenever she passes away, then that we're going to have that income stream go to the kids,
Mhm.
and there's no penalty there. And so
Okay, wait, explain that one more time. So when the individual passes,
right.
mhm,
So when the individual passes, the income stream. So normally, typically, when the individual passes, then whatever is left goes to charity.
yeah,
In this case, we could have where the individual passes, and we can have a secondary contingent beneficiary. The kids get the income stream for a certain amount of time.
okay, what is that time limit?
It's 20 years is the total time. So if you do with joint lives, then it's the longer of whoever lives the longest. In this case, they're saying 42 years. If I
Oh,
say that, I want that even when I pass away or the lady passes away, that she wants to go through her kids, then there's a 20-year certain. And so the trust will last for 20 years.
yeah, so
So if
that
you
the
pass with,
funds remain invested
right,
for 20 years, and then when the 20 years is over, the funds are then donated to the charity.
right. And then the kids will step into mom's place and get the income stream instead of her.
Wow, that's really great.
That's,
I don't
yeah.
know why I didn't understand that part, but that's really fantastic.
Yeah, and a lot of people don't know about that part. They assume that a charitable trust is
Yeah,
only for the husband and wife or one of the two, right? But you can do it for, I won't get into this, but one time I actually did it where there was a man who's already divorced, and he did a charitable remainder trust. He put his commercial building in it, but he had the income stream when he passed go to his new girlfriend,
mhm.
and but it can last only 20 years. But he also reserved the right to revoke that income interest if the relationship went bad.
Hmm, that's interesting because that would be like plenty of money to give your children for 20 years, 200,000 split between, I'm thinking my children, 3.
Yeah.
That's really interesting. Okay, very, very interesting, Andrew. Have we touched on most of the points, do you think, about the charitable remainder trust?
Yeah, I think the charitable remainder trust is great again for if you're not going to sell your house, then
Mhm.
don't put it in a charitable remainder trust.
Yeah,
This is only useful if you want to sell and not pay the tax.
right,
So
right.
3 benefits again: avoiding the capital gain, getting an income tax deduction, getting an income stream for the rest of your life, and getting that asset outside of your taxable estate.
Yeah, that's really terrific. Let me just see if we have any questions on Facebook. And I know we have Megan and we have Linda here joining us. So if either of you have a question for Andrew, that would be terrific as well. Linda, Megan, do you guys have any questions? Tori, do we have any questions? Let's see. We have one. Um, is there actually a minimum contribution to open up a charitable remainder trust?
No, there isn't a minimum, but again, for an attorney to draft a trust, it'll cost somewhere between 5 and 20,000. So
Mhm.
you have to figure out, is it worth it or not? If you're selling your house for 500,000, right, or 1 million, and you're avoiding gain on, let's say you're selling your house for 1 million and you're avoiding gain on 700,000, I would say it's worth it.
Yeah, and then that is actually income, right? That
Right.
you receive. So I'm just thinking for someone like my friends that are thinking down the line about selling, and I was thinking they'll probably have maybe $1 million gain
Yeah.
after capital gains because they bought the house for like 350, and there's
Right.
two of them, so that's 850.
Right.
So maybe 800,000 to 1 million they may have. Um,
So they bought a house for 350, and then what happened? Where do you get the 850?
I was just thinking about the gain that would be there.
Oh, got it.
If they sold it for 1,800,000,
Got
it would be 1.5 minus they're married 500,000 for
Right.
the exemption. They would be taxed about a
Got a
million.
$1 million gain. And
Yeah.
that $1 million of gain, the IRS will tax you on your long-term capital long-term capital gains rates, but the franchise tax board will tax you on as ordinary income.
Mm-hmm.
And so they're going to be paying somewhere, $370,000 to $400,000 of taxes.
Mm-hmm. Yeah. Yeah. 300, what did you say? 370?
370 to $400,000 of taxes.
That's what I thought. Yeah. So they don't have a lot of choices. Either you pay it or maybe this is an option. I don't know.
Here's the other thing is that some people are saying, well, maybe I don't want so much to go to charity. Maybe I want more to go to my kids, right?
Mm-hmm.
So one of the ones that I did, they wanted cash flow of a certain amount per year, and they got more than that. And so they took some of that cash flow and funded a second to die life insurance policy. So remember, this money doesn't go to charity until they both pass away. So the second to die life insurance policy will pay when they both pass away. At the same time the money goes to charity, a second to die life insurance policy replaces that money goes to charity to the kids. So that's called a wealth replacement trust.
Oh,
So they don't have to worry about, losing, the kids don't have to worry about losing that inheritance. They're getting the tax deductions up front, and they're just replacing the money going to charity with a secondary life insurance policy going to the kids. They replace the money going to charity.
that's a really good option. Yeah. I think that would be the one concern that people have is like, wait,
Right.
This is my largest asset.
Right.
I want my children to have it.
Right. So that'd be one way to solve that, is a solution to that is, I don't want so much to go to charity. I want to go to my kids. That's one solution for that.
Okay. That's a great solution. Let's see, what are the first steps for someone wanting to set up a charitable remainder trust? Someone asked that.
Well, as a courtesy to your clients, I'd be open to having a discussion with them. And, I would need data. So the tax deduction and the cash flow and all that is based on a couple of different things. Based on the IRS interest rate on the month you set it up, based on your age, your dates of birth, and based on what type of income stream you want. You want 5%, 6%, or 7%. And so after, I can run numbers. And as a courtesy, Cynthia, I really respect, again, a lot of what you do and how you want to really help your clients. I'm open to doing a complimentary consultation to help run the numbers and speak with your clients, either with you on the line or separately, whatever is most convenient and best for your clients.
Oh, that's great. You're just so generous with your time, Andrew. I really appreciate it. I know Megan Torres is here with us, and she did raise her hand and has a quick question. Megan?
It's Cynthia. It's actually me. I don't know why Megan's name is on there twice. How are you?
It is up there twice. Okay.
It's weird. Anyway,
Yeah.
Thank you. I love the info. Just had a quick question. Well, a couple questions. First one would be, can you split this into two charities? So let's say I have a difficult time deciding which charity I would like that to go to. Is there a way you can allocate the proceeds of the sale of the property to different charities, or is it just one?
That's an excellent question. And you can do multiple charities. So you can say, half of it goes to Huntington Library, half of it goes to the Disney Concert Hall, whatever, right? Or half of it goes to UCLA or USC. And I normally get involved. I don't do the legal work, but you can actually put in clauses there where you can change the charity later on. Let's say 5 years from now, you go, you know what? I don't think I really like that charity anymore. You can change it. The most flexibility comes when you create, and you're not Megan Torres, but we'll create the Megan Torres Charitable Gift Fund. So that money goes into a fund for charity. It's kind of like a conduit, kind of a holding tank for it to go later on. And that's where your kids can get involved in deciding where that money goes to. Whereas if you actually name Huntington Library or Descanso Gardens or whatever it is, it's stuck there unless you change it. But if you have it to a gift fund, a charitable gift fund, kind of like it's called a donor advised fund, then it gives you a lot more flexibility. So that's what I normally do for my clients.
Oh, that's great.
Thank you, Andrew.
Yeah.
Well, Andrew, thank you so much for your time. So what is the best way for anyone listening to contact you for more information?
Yeah, so the best way to contact me is through my email address, andrew.low, that's L-O-W, at ubs.com. That's andrew.low, L-O-W, at ubs.com. Or reach me on my phone, 949-331-5181. I'm here in Newport Beach. I have a sister who lives in San Marino, so I'm into the Pasadena area all the time. Actually, once upon a time, 30 years ago, I worked in Pasadena.
You did? Ah.
But I'm happy to take a phone call or an email and arrange a time to do a consultation.
Oh, that's great, Andrew. And honestly, anyone listening to this call today, if this conversation does pique your interest in any way, you can always reach out to me and I'm happy to make an introduction to Andrew. You can either email me at cynthia@cynthiacohn.com. You can reach us on the website, cynthiacohn.com, or give us a call at 66714-6808. And again, I'm the owner of Cynthia Cohn and Associates, actually one of LA's very few woman-owned residential real estate brokerages. And to us, there's nothing more important than you, your dreams, and your goals. And our mission for the company is very simple: to really provide you and your family unmatched value by delivering world-class protection, heartfelt care, and guaranteed results when you need and really deserve it most, when you're selling your largest asset. And if you're interested in selling or buying a home, please don't reach out to me. I'm always happy to sit and we can have a Zoom or a coffee locally. And I'm happy to bring you up to speed on the trends and what we're seeing in the market. And I do say it's November. I always believe that November, December, and January are the best months of the year to purchase property. So any of you all listening today, if you haven't gotten pre-approved, just to see what you can do with your own financial opportunities, it's a time to do so, and maybe you will snag a really good deal that's out there. So I'll be sending out a follow-up email with more information and Andrew's contact information. And I know Andrew would be more than happy to answer any questions that you have. So thank you again for joining us today at this Fireside Chat, and I hope you guys have a fantastic evening. Andrew, thank you so much.
Thank you so much for having me. Happy Thanksgiving. Happy Veterans Day to everybody.
Thank you. And thank you so much. And I'll see you soon. All right. Bye-bye, everybody.
Bye-bye.